Welcome back to the Deep Dive. We're the show that really tries to get past the surface noise in financial reports, find the actual signal. And today our mission is, well, it's a deep dive into the Q3 2025 earnings for BigBear.ai Holdings. That's BBAI. Now, look, if you just saw the headlines, it probably seemed pretty straightforward. A BBAI got that double beat expectations on revenue, beat on earnings per share. But as we know, anyone who follows the market closely knows these headline wins, they can often be, well, let's just say creatively assembled. Accounting tricks, one-off events, sometimes just really, really low expectations from Wall Street. So we need to ask, was this quarter actually good operationally, or was it just good on paper?
That really is the key question, isn't it? And the source material we're using, it gives us a pretty solid framework. It's a 5-part structure that lets us compare BBAI's own numbers directly against what the market was expecting. It helps us get beyond just the top line, look at the quality of the earnings. And our goal for you listening is not just to see the numbers flash by, but to really grasp the difference between, say, a reported GAAP profit, which often has all sorts of non-cash stuff baked in, and how healthy the actual core business is. Is the AI engine really firing, or are they just, buying time for a big change?
Okay, yeah, let's definitely unpack that. We'll follow the framework laid out in the analysis. So jumping right into our first segment here, now for section 1, the at-a-glance scorecard. This is where we put reality side by side with expectations, and we immediately hit the central puzzle.
Exactly. So BBAI did get that double beat label. And, we have to acknowledge they did clear the bar the analysts set, even if maybe that bar wasn't set incredibly high going into the quarter.
Right, let's get specific on that beat. Revenue came in at $33.1 million. The Wall Street consensus was $31.82 million. So, okay, it's not a massive beat, but it's slightly ahead. A win is a win, mathematically.
And the earnings per share, the EPS beat, that was there too. Analysts were looking for a loss around 7 cents, $2.07 per diluted share. BBAI reported a loss of only 3 cents, $2.03. So, in the immediate term, the market probably breathes a little sigh of relief. Things weren't quite as bad as feared.
But then the second you switch from looking at expectations to looking at how they actually performed compared to last year, the whole story just flips, doesn't it? This is the contradiction we've got to solve. Total revenue year over year dropped sharply, down by, 20.1%, from $41.5 million in Q3 last year down to $33.1 million this quarter. That's not just a little softness. That's a serious decline in the main business.
And here's where it gets really kind of head-scratching. At the same time, they lost a fifth of their revenue, their net income. It swung wildly from a big loss last year, $15.1 million, to actually reporting a profit this quarter, $2.5 million profit.
Wait, hang on. Revenue down 20%? Profit appears? That doesn't make sense. Usually losing that much revenue would make your losses worse, not turn them into a profit. That's just not how businesses normally work.
It's a perfect example of where GAAP accounting, generally accepted accounting principles, while technically correct, can give a totally misleading picture of what's happening underneath. That profit swing, purely an accounting creation. The sources are very clear on this. That $2.5 million net profit had absolutely nothing to do with selling more AI or finishing profitable projects. The report says it was primarily driven by non-cash changes in derivative liabilities of $26.1 million.
Okay, slow down. Derivative liability, non-cash changes. That sounds very financial engineering 8. We need to break that down. What's going on with that $26.1 million gain? What are these derivatives?
Right. So these are usually complex financial things BBAI has on its books, maybe warrants, maybe convertible debt they issued before. They're liabilities because theoretically the company might have to pay out cash or issue more stock later to settle them. And GAAP rules say you have to adjust the value of these liabilities on your books every quarter based on market conditions. Now here's the kicker. If the market value of those liabilities goes down, maybe because the company's stock price fell, making warrants less valuable, or interest rates changed, then the company's potential future obligation shrinks. And that decrease in their liability gets recorded on the income statement as a gain, a non-cash gain. It's not real money coming in the door.
I think I get it. So let's say BBAI's stock price was doing poorly. The warrants linked to the stock become less attractive, less valuable. So BBAI's future obligation to honor them decreases on paper. And that decrease gets booked as this huge $26 million paper profit.
You've got it exactly. That $26.1 million non-cash gain acted like this giant accounting cushion. It was big enough to completely soak up all the money the actual business operations were losing and still leave enough left over to show that $2.5 million GAAP net profit on the headline. It's a paper phantom, really. hides the real operational losses.
Right. Makes the financials look okay, even though the core business is shrinking. But hang on. If they booked a $2.5 million profit, why was the diluted EPS still negative? Why a loss of $2 or 3 per share? That seems backward.
Uh, well, that leads us to the other massive factor that hit in Q3, dilution. Shareholder dilution. You have to look at the denominator for EPS, the number of shares. So basic EPS, which just uses the shares outstanding right now, that did show a tiny profit, like plus $0.01. But the number investors really care about is diluted EPS. That number assumes all those potential shares out there, from warrants, convertible notes, everything get exercised. It shows the worst case scenario for existing shareholders.
And they've been raising a ton of money by selling stock, haven't they? We'll get into that later, but that had a direct effect here, right?
Oh, a massive effect, a huge one. BBAI's diluted share count for this quarter, it exploded, up 79.3% compared to last year. It hit almost 450 million shares, 448.16 million to be precise. Think about that, nearly doubling the number of slices you have to cut that tiny $2.5 million profit into.
Wow. Okay, yeah. When you spread a small non-cash gain across nearly 500 million potential shares, the value per share just vanishes. It completely overwhelms that accounting profit.
It absolutely does. So even the temporary boost from that derivative accounting trick wasn't enough to keep the per share number positive because they'd flooded the market with potential new shares to raise cash. So slide 1 basically tells this story. Operations declining, that's the revenue drop masked by an accounting trick. The derivative gain, whose benefit was then immediately canceled out for shareholders by massive dilution. That's the real picture from the scorecard.
Okay, that makes sense. And it sets up our next section perfectly. Since that headline profit wasn't real, we need to look under the hood at the actual engine. Let's move to section 2, the engine of profitability. This is all about the quality of earnings, the core operational health.
Right. This is where we strip away all that financial maneuvering and see if the company can actually make money from its day-to-day business. And the picture here is not pretty. The margins got worse pretty much everywhere.
Let's start at the top with gross margin. That tells us how much profit they make on their actual services or software before covering overhead like sales and admin costs.
Yeah, the gross margin rate fell noticeably. Went from 25.9% in Q3 last year down to 22.4% this quarter. And in dollar terms, that's a $3.4 million hit. Gross profit dropped from $10.8 million down to just $7.4 million. Now, management tried to explain this. They said they had some higher margin programs in the third quarter of 2024 that were not repeated. And look, that explanation itself is actually pretty worrying. It suggests the 20% revenue drop wasn't just losing any contracts. They specifically lost their most profitable ones, which means the business they still have is inherently less valuable, making it even harder to get back to operational profit.
Ouch. So selling less and making less profit on each sale they do make. That's a double hit right there on the top part of the income statement. And then you factor in the overhead costs, the SG&A, and that's where the operating margin really falls apart, right?
It falls off a cliff here. The company's loss from operations, it more than doubled compared to last year. It ballooned to a $21.9 million loss in Q3 2025. Compare that to a $10.5 million loss a year ago.
Doubling your operating loss in a year, that's accelerating cash burn. That can't go on forever without some kind of lifeline. What drove that huge increase? We know gross profit fell, but what about the overhead? Did that go up too?
It did. It was a combination punch that made it worse. First, yes, the falling gross profit we just discussed. But second, there was an $8 million increase in selling, general, and administrative expenses, SG&A.
Wait, an $8 million jump in overhead while revenue is shrinking 20%. That's really bad synergy. What are they spending that extra $8 million on? Are they hiring more salespeople, or is it costs related to maybe managing all that cash they raised?
The reports don't give us a super detailed breakdown, but yeah, we can make some educated guesses. Given the huge amount of cash they raised, which we'll get to, and the big acquisition they announced right after, it's very likely a chunk of that $8 million went towards M&A prep costs. Maybe hiring expensive advisors, maybe bringing on new executives to handle the strategy, or even just accelerated R&D trying to build up their own Gen AI stuff before the deal closed. Costs aimed at the future, maybe, but absolutely crushing profits now.
Right. And this dynamic, cost going up while revenue goes down, that's what they call negative operating leverage, isn't it?
Textbook definition, yeah. Negative operating leverage basically means your cost structure is too heavy for the amount of business you're doing. You're actually getting less efficient. It really points to a legacy business model that's maybe fundamentally broken, or perhaps more likely here, one that's being deliberately wound down or ignored in favor of the new strategy we'll discuss. The old machine is just running really inefficiently now.
Okay, so this leads us to maybe the most crucial comparison on this slide. That GAAP net income versus the non-GAAP adjusted EBITDA. We know GAAP showed that $2.5 million profit because of the accounting trick. What does adjusted EBITDA, the measure of operational performance, show?
It shows the cold, hard reality. A loss of $9.4 million. That's the real operational pulse. And look at the swing a year ago. Q3 2024, they were slightly positive, adjusted EBITDA of plus $2.9 million. Now, a nearly $10 million operational loss.
Wow, that swing from just barely positive to almost negative $10 million in 1 year, that's brutal. It shows the operational cash burn is getting worse fast. Can you walk us through how they get from the $2.5 million GAAP profit down to that $9.4 million operational loss? What are the big adjustments?
Yeah, looking at that reconciliation is key. Management basically takes the GAAP number and strips out all the stuff that isn't core or isn't cash to show the underlying operational trend. And the single biggest adjustment they make, you guessed it, they remove that $26.1 million non-cash gain for the derivative liabilities we talked about earlier. As soon as that paper profit is gone, boom, the underlying loss is exposed.
Okay, that makes sense. What else are they adjusting out?
Well, they add back several other non-cash costs. The biggest one is about $5.2 million in equity-based compensation stock options and grants for employees. Now, under GAAP, that's a real expense. But since the company isn't actually writing a check for it, it doesn't affect their cash position day to day. So non-GAAP metrics often add it back to give a clearer picture of cash profitability. They also add back some smaller things like about $7.7 million in restructuring charges, little cleanup items.
Got it. So take out the big paper gain, add back the big non-cash expense like stock comp, and that math gets you right to that $9.4 million operational loss. That really feels like the most honest number reflecting how the core BBAI business actually did in Q3.
Absolutely. It's the number that tells you the company is burning cash faster and faster, just running its existing operations. And that really necessitates looking at the next part of the story.
Exactly. Since the operations are bleeding cash and the losses are accelerating, we have to look at their financial foundation. Let's move to Section 3, Financial Strength and Shareholder Rewards. The big question here is, how much runway do they have to keep losing money, and where did that runway come from?
Yeah, the balance sheet here it's a real study in contrast. The operations are sputtering, but the company's financial structure, well, it's incredibly strong now. It's all about the cash. They reported a record cash balance of $456.6 million at the end of September 2025.
Nearly $500 million in cash. That's huge, especially when you compare it to where they were at the end of last year, 2024. They only had about $50 million then. So almost a tenfold increase in cash in just 9 months. Where did all that come from?
Well, one thing's for sure, it didn't come from profits. We just established operations were burning cash, right? That $9.4 million EBITDA loss confirms it. No, this cash came entirely from the financing section of the cash flow statement. And this connects directly back to that massive dilution we talked about in Section 1. If you look at the cash flow statement for the first 9 months of 2025, it shows they raised a staggering $637.1 million from proceeds from at-the-market offerings.
Okay, at-the-market offerings, ATM offerings. Let's explain that. That means BBAI was basically continuously selling brand new shares of its stock directly into the public market over those 9 months, right? Just dribbling them out to raise cash whenever they could. $637 million in 9 months. That is a lot of stock selling for a company this size.
It's incredibly aggressive. Opportunistic, you could say. Maybe even a bit desperate, depending on your view.
Yeah.
Companies use ATMs because it avoids the big price drop you might see with a single large secondary offering. But that $637.1 million, that is the exact price tag for the 79.3% explosion in the diluted share count we saw back in Section 1. They literally traded future shareholder value, that dilution, for this massive pile of cash today.
Right. It connects perfectly. The $637 million raised explains the huge cash balance, and it explains why that non-cash GAAP profit got completely diluted away on a per-share basis. A direct trade-off.
It's a classic financial engineering move, and you have to admit, look what it did for their solvency, their overall financial health. That cash completely flipped the balance sheet. Remember, at the end of 2024, their total stockholders' equity was actually negative, a deficit of $3.7 million. Now, it's a positive $610 million. They went from technically insolvent to fundamentally stable purely because of that cash infusion, despite the ongoing operational losses.
And what about their debt? Does all this cash make their existing debt load seem small?
Pretty much, yeah. Their total debt is around $113.4 million, and most of that is long-term debt, so it's manageable. And when you calculate their net cash position, That's the total cash minus the total debt they're sitting on, about $343.2 million in net cash. That gives them enormous flexibility, huge liquidity. They aren't facing an immediate crisis from the operating losses anymore. Even if those losses keep growing for a while, they've bought themselves years of time. And crucially, they now have the capital they need to make a really big company-changing strategic bet.
And that strategic bet is exactly where we need to go next. Let's pivot to our final section, Section 4, the road ahead management's outlook and key takeaways. This is where the narrative really shifts from, struggling old business to maybe a speculative new AI platform.
Okay, first, let's just quickly touch on management's guidance for the rest of this year, 2025. They reaffirmed their full-year revenue target. They still expect between $125 million and $140 million.
Okay, let's do the math on that. They've already booked $114.4 million through the first 3 quarters. So to hit that range, what does that imply for Q4 revenue? It means Q4 revenue needs to be somewhere between, only $10.6 million on the low end and up to $25.6 million on the high end. That range is incredibly wide.
It really is. And a range that wide, a spread of almost 150% between the low and high estimate, that screens uncertainty. It tells you they're probably waiting on 1 or 2 significant contracts to land before year end. If those deals close, they hit the high end. If they slip into next year, Q1 2026, then Q4 revenue could be really weak, down near that $10 million mark.
Yeah, and the CEO, Kevin McLennan, he even acknowledged some of the problems he mentioned, delays resulting from the government shutdown, and also lower volume on certain Army programs. So confirmation that the traditional legacy business is definitely facing headwinds, both external and internal.
Exactly. But honestly, the weakness in the legacy business now almost feels like just context. It's the backdrop for the real story of Q3, which was that huge strategic pivot they funded with all that cash they raised.
Which brings us squarely to the biggest news, the acquisition of Ask Sage.
This deal, this M&A, it is the new investment story for BBAI, basically. They announced they're buying Ask Sage, described as a fast-growing generative AI platform. And they're using that balance sheet strength, deploying the cash they got from selling all that stock to fundamentally change the company's direction, almost overnight.
And the price tag is $250 million. So a big chunk of that cash they raised is going right out the door for this. This isn't just adding a small feature. This is a major strategic buy. What exactly are they getting for that $250 million?
Well, they're buying a position in what they hope is the future, AI for defense and national security. Ask Sage is described as cutting edge for those sectors. And here's a key detail. The sources say it already supports more than 100,000 users on 16,000 government teams. That's potentially a massive built-in customer base that BBI can now try to sell its other older stuff into, maybe, or just leverage for Ask Sage itself.
Okay, let's talk valuation. $250 million purchase price. Ask Sage is expected to do about $25 million in annual recurring revenue, ARR, this year, 2025. That's a 10x ARR multiple. Is that expensive, or is that just the going rate for hot Gen AI companies right now?
Well, it's definitely a premium valuation, no doubt. A 10x forward ARR multiple, it's rich. It reflects both the hype around generative AI, especially in defense, and probably also BBI's urgency to buy growth because their old business is shrinking. How does management justify it? By pointing to the growth. They expect Ask Sage's $25 million ARR this year to be a 6 times increase compared to its 2024 ARR. So that kind of hyper growth, $25 million ARR growing 6x year over year, that's the kind of explosive growth BBI investors probably hoped the whole company would achieve, but the legacy side just couldn't deliver. They're essentially buying the growth they failed to build organically. It's a calculated gamble. The CEO's goal seems clear. He said he wants to create a secure, integrated AI platform. So if you invest in BBAI today, you're not really betting on their old government data analytics contracts anymore. You're betting they can successfully integrate this expensive, fast-growing Ask Sage acquisition and make it work within the defense world. It's an M&A story now.
Right. So the entire reason to own BBAI stock fundamentally shifted this quarter. They diluted shareholders massively to get cash, use a big chunk of that cash to buy very rapid growth via Ask Sage, and now the challenge is smashing those two pieces together, the new growth engine and the declining legacy business.
That perfectly sums up the narrative arc of Q3. The headline beat was just noise. The real story was this massive strategic pivot.
Okay, let's wrap this up by crystallizing the key takeaways from our whole deep dive. Let's summarize the absolute must-know points for listeners.
Okay, recap point 1. That Q3 beat on earnings and revenue, pretty much irrelevant when you look closer. It completely hid the fact that the core legacy business is quite sick. Revenue dropped over 20% and operational profitability just collapsed. Adjusted EBITDA swung from slightly positive last year to a nasty $9.4 million loss.
Recap point 2. The $2.5 million JAP profit was pure accounting magic. It came entirely from that $26.1 million non-cash gain on derivatives changing value. It made the books look better temporarily, but the benefit to shareholders was wiped out anyway because they issued so many potential new shares, that 79.3% dilution.
And recap point 3. BBAI aggressively sold stock, raising over $637 million to build this huge cash war chest. They're now spending that money, starting with $250 million to buy Ask Sage, a high-growth generative AI company. This signals a very deliberate, very sudden shift away from the struggling old business toward a completely new AI-focused strategy. So the final thought maybe for you to consider is this. BBAI used financial maneuvering to literally buy itself a new future. They have the cash now, the runway is there, but the hard part, the operational execution, is just beginning. The really big question going forward is, can they actually integrate Ask Sage smoothly? Can they blend this fast-growing, premium-priced AI asset into their older, shrinking government services structure? And can they do it fast enough to start generating real profits before they burn through the rest of that cash? That integration risk. That's everything for BBAI now, just the usual reminders. This report is for informational purposes only. It doesn't constitute financial, investment, legal, or tax advice. Please do your own research.
All investment decisions should be made based on your own work and in consultation with a qualified financial professional. Also, remember this report was generated by an artificial intelligence model, integrating company data and market data. All the info, numbers, calculations, you should really verify them independently before making any decisions based on them.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.